Hi, this video is the most definitive guide to the Ichimoku cloud analysis and trading strategy. Conceived by Professor Aldo Lagruta of the Technical Analysis Institute. This course was designed to quickly transform struggling traders into market maestros. Celebrated as our best seller for 5 years, today we're dropping this treasure entirely for free. In just an hour, you'll learn everything you'll ever need to know about the Ichimoku cloud.
In this short course, we will focus on a particularly easy and effective technique of technical analysis to identify the trend at a glance. I'm talking about cloud charts. This technique is widely used today, and it is rare to visit a dealing room and not see the Ichimoku clouds on virtually every screen. But to be honest, very few people know what to do with the clouds and how to interpret them. So in the next lessons, we're going to explore the Ichimoku clouds in detail, its origin, construction, and interpretation. In the 1940s, a Japanese journalist by the name Goichi Hosada began to effectively analyze share prices by refining the use of candlestick charts. In order to make his interpretations more precise and accurate, he added several moving averages, and in 1968, he made his methodology public. In his publications, he used the pseudonym Ichimoku, which means at a glance. And that is exactly what Ichimoku clouds allow you to do. Get a lot of information about the market you are analyzing at a glance by using cloud charts. Originally, Ichimoku clouds were thought for medium to long-term trading. Therefore, they are typically used in daily charts. We personally find that the information they provide in daily charts is very accurate, and it helps me a lot to identify areas of support and resistance, as well as potential targets and projections. Although they are not meant for day traders, I have seen technicians using them effectively all the way down to 15-minute charts. The truth of the matter is that when you start experimenting with clouds, you may find that you can use them in any time frame, so don't be afraid to start using them as you learn how to interpret the information they provide. But start first using the daily time frame in order to prove their effectiveness in your analysis, and thereafter move on to lower time frames, experimenting with their signals until you find an ideal time frame for your personal use in combination with your favorite trend following indicator. So this is how they look. At first, they look very complicated, but please bear with me. Don't let the cloudiness of this chart put you off. You will find that from all the techniques you will learn in a technical analysis course, this is probably one of the most powerful ones. And why? Because you'll soon learn that clouds are one of the easiest and most effective ways to identify the trend despite their look. To make it easier for you to understand them, I will separate the 5 different components of clouds and erase the rest from my chart. But first, let me label each one of these elements so you get familiar with the whole cloud. Of course, all these components have Japanese names, but I personally find it very confusing to try to learn and use the Japanese terms that are found in books. After all, our objective here is to learn technical analysis, not a second language. Therefore, we will stick to the English names. It can be confusing, however, because many analysts will use different names because they are using translations from the original Japanese. So we will try to use the most obvious ones interchangeably. For instance, instead of talking about the Tenkan-sen for the 9 moving average, we will call it the turning line or conversion line. Or we will simply call it the 9-period moving average or even the fast moving average. The standard line is also translated as the baseline. We will call it standard line or the slow moving average. Let's just try to make this easy and more related to technical analysis instead of language. With all that said, let's start from the most familiar aspect of the cloud and build from there. Obviously, the turning line and the standard line, as I just hinted, are just 2 moving averages. But are they the typical moving averages we find in all trading platforms? Not really. While they are clearly a fast and slow moving average, 9 and 26 period, They are not exactly like the moving averages we are used to. This is the same chart as before, but I have erased all the other elements of the cloud and left only the fast and slow moving average, which we also called turning and standard line respectively. The first question people ask me is, why the 9 and 26 period? The reality is that there is no magic to moving averages. Hosada used the 26 period based on the fact that in Japan there was an average of 26 working days in a typical month. The 9 period was simply the one that worked best in conjunction with the 26 period after extensive testing. Obviously, you could attempt to change these periods based on the fact that we don't actually have a 26 working day week in a month. But the difference is not really substantial or worth the effort, so my recommendation is to leave it as it is. Now let's examine what these two moving averages tell the analyst. The first most obvious information is similar to any other moving average. It tells you what trend you are in. Obviously, the degree of the slope reflects the strength of the trend. And secondly, it also gives you levels of support and resistance, which are key in your trading decisions. And as well, it gives you buy or sell signals on the crossover. Let's do a quick analysis of this chart using only these two moving averages. First, we can see the crossover at the bottom left of the chart. The short-term average in this case crossed the longer term from below. That is in itself a buy signal. Once the short-term line is above the longer-term one, the trend is up and higher prices are to be expected, as it happened clearly on this chart. The opposite indicates a sell signal. That means that when the short-term average drops below the longer one from above, that is a sell signal. And these positions are supposed to be held until an opposite signal occurs. You will notice that on this chart, a buy signal was given at about 48.38, and the sell signal did not happen until the market was trading at about 63. That's about $15 in profit later. The slope of the standard line tells us that the uptrend is strong. If it were moving up gently or if it were flat, then we could think that the trend is sideways. But in this case, we have a kind of an ideal 45-degree angle that argues for a continuous uptrend. But that's not all. I mentioned that these moving averages provide us with levels of support and resistance that are key for your trading decisions. So let's examine that. In an uptrend, as the one we see on this chart, prices are expected to correct. A trend never moves in a straight line, so pullbacks are expected and used as opportunities to join the uptrend. The question is, how far can we expect the pullbacks to go? This is a very important question we always have when we see a market trending, and that's where these two moving averages are so helpful. In an uptrend, prices typically first find support on the 9 period because this one is closest to price. Thereafter, the 26 period acts as support. This chart gives us some nice examples of how prices found support on the 26 period during more meaningful retracements, and other times on the 9 period during small, shallow corrections. But wait, aren't these two normal moving averages? How can they give such good levels of support and resistance? Well, not really. They are indeed constructed as normal moving averages, but instead of averaging each day in that period, they are calculated by the overall midpoint between the highest daily high and the lowest daily low in the period. So let's say that we wanted to calculate the 9 moving average for our cloud. Then we would take the highest price and the lowest price over the last 9 days, and we will add them together, divide them by 2, that would be our turning line. Of course, all this is done automatically in your trading platform every single day. But I just wanted you to understand why the turning line and the standard line look different than moving averages of the same period. The standard and turning lines are less smooth and more jerky, thus giving us those nice horizontal places for support that you see on this chart. And speaking about those horizontal periods, When you see them on the 26, the slow-moving average, for several days, as you can see in the same CL chart a few days later, it is a clear sign that the market is not trending. The standard line and the turning line are both moving averages with slightly different calculations. Therefore, they are trend-following indicators. And besides all the valuable information these two lines give to the astute analyst, they serve a more valuable purpose when it comes to the construction of the cloud itself. In the previous video, we mentioned the fact that Ichimoku charts have several components. The cloud itself is but one of them. So in order to interpret Ichimoku charts correctly, we must look and understand the information that all its components provide us as a whole. You already know a lot about the construction and interpretation of the standard and turning lines, so it is time to explore the cloud itself. The cloud, as you can see on this chart, is the colored space between two lines, cloud span A and cloud span B. Let's talk briefly about the construction of these two lines, so you can have a sound understanding of where all this information comes from and its implication. Cloud span A is calculated by adding the values of the two moving averages we discussed in the previous lesson and dividing them by 2. This line is then plotted 26 days ahead of the last complete day's trading. To put into simpler words, span A is simply the midpoint between the fast and the slow moving average, but shifted 26 bars forward. Obviously, this shift into the future is one of the unique aspects of the cloud, and perhaps one of the most helpful values it provides. Naturally, it goes against all the ignorant traders who, against all evidence, deny the possibilities to forecast the markets using sound analytical tools. Cloud span B is calculated in a way that is neither related to the standard nor to the turning lines, yet uses a similar process for its construction. Instead of using the standard and turning lines, it uses the middle point of the last 2 trading month sessions and shifts it 26 bars forward just like span A does. Basically, it finds the highest price of the last 52 days, adds it to the lowest price during the same period, and divides it by 2 to obtain the midpoint of the last 2 months of trading. On this chart, for instance, you can see 3 horizontal lines. The first one in black measures 52 bars, which in this case corresponds to 52 trading days. The black dotted vertical line measures the highest and lowest points within those 52 days. The light blue horizontal line shows the midpoint between the high and the low within those 2 months of trading. And finally, the small red horizontal line shows 26 bars ahead where the cloud span B was located. The most important thing to keep in mind about the construction of span B is that being the midpoint of the past 52 days of trading, it is similar to the 50% Fibonacci retracement that Charles Dow and Ralph N. Elliott observed, but shifted into the future. Dow noticed that the market typically retraced between 1 to 2/3 of the previously traveled distance. Elliott was a lot more precise and argued for 38 to 62% retracement. The point in between is the 50%, and that is precisely the point that most serious analysts watch for support in an uptrend or resistance in a downtrend. The space in between span A and B is typically colored or shaded, and that is what we refer to as the cloud. As time goes on, because of the clever construction of the cloud, support and resistance levels will remain constant at the 50% level during consolidation periods. I think it's worthy to keep in mind that the cloud is the result of 2 moving averages, a slow and a fast one crossing each other and shifted ahead in time. So what does this mean in practical terms for you? It simply means that if the shorter period, span A, crosses the longer period, span B, from below, then prices are running up faster in the short term than they are longer term. And while the span A remains above the span B, the market is bullish and the cloud will be colored accordingly. The color is not significant. The important thing is to recognize that as the market is bullish, the cloud will be in one color, and when it turns bearish, that color will change. In the case here, my platform colors it green for bullish and red for bearish, but other platforms will have different colors. When span A is below span B, it means that prices are falling faster in the short term. This is bearish, and the cloud will be colored accordingly. Here on this trading platform, the color to indicate a bearish market is red. Generally, if the market is in an uptrend, the cloud will be rising, and if it is in a downtrend, the cloud will be falling. Just for the sake of making the materials of this module more easily accessible and easier to understand, one of the things that some people object to about cloud charts is that in their construction, they project prices, support, and resistance levels into the future. Some people argue that that's a type of divination without any foundation. The reality is that most serious analysts use trend lines. If you're still not using trend lines in your trading, you are simply neglecting one of the best and most simple tools available that technical analysis has to offer. But if you do use trend lines, you will agree that those lines are typically extended into the future to spot areas of support and resistance, and that technique works with amazing accuracy. So the Ichimoku clouds use the same idea, but their calculations to project into the future are more sophisticated than trend lines. And there is something fascinating about Ichimoku clouds. Not only they use calculations to project into the future, but they also use calculations that are shifted into the past. Such is the case of the last component of Ichimoku clouds, the lagging line. This line is constructed by shifting the price line back 26 sessions. While the cloud is shifted 26 bars forward, the lagging line is shifted 26 bars backwards. On this chart, you can see only the lagging line. I erased all the other elements of the cloud so you can have a clear image of the lagging line. You can clearly see how it is mirroring the price action, but 26 bars behind. The most important aspect of the lagging line is that it acts as a confirmation signal. In fact, it is its interaction with span B that is considered a major signal on a cloud chart. On this chart, you can see the lagging line crossing span B from above on the upper left-hand part of the chart. While the cloud remains bullish for several sessions ahead, evidenced by the green color, the crossing of the lagging line over the span B to the downside is a sell signal. That signal resulted in a major sell-off in this particular chart. This next chart shows us the opposite situation when the lagging line crosses the span B from below, resulting in a major buy signal. Again, the cloud itself remained bearish for the next few sessions, but the signal resulted in a major rally. So putting it all together, cloud charts have 5 components. 1. The turning line, the midpoint of the high and low of the last 9 sessions. The standard line, the midpoint of the high and the low of the last 26 sessions. Cloud span A, the midpoint of the turning line and the standard line shifted 26 bars forward. Cloud span B, the midpoint of the high and low of the last 52 sessions shifted 26 bars forward. And finally, the lagging line, the price line shifted 26 bars back. When I describe the lagging line as the same as the price line but shifted back, I am referring to the closing prices. Therefore, if we were to use a line on close only in combination with the lagging line, we would see 2 exact lines mirroring each other. But the lagging line will be behind. To illustrate my point, this chart shows you a line on close in red together with the lagging line of the cloud in blue. You can see they are the exact same line but shifted. In this next chart, I added the cloud so you can see a fuller picture. It's worth noticing that some analysts prefer using this configuration for clarity. but it misses the information provided by the turning line and the standard line. And on this last chart for this video, I have put all the components of the cloud together. By now you can identify them all with relative ease. The fast and slow moving averages, the cloud itself formed by the span A and B, and finally the lagging line. You now know all the components of cloud charts, the way they are constructed, their implications, etc. In this video, we are going to dig further into cloud reading and interpretation. While cloud charts have a variety of uses, I believe we should start from the most obvious and perhaps the biggest advantage that Ichimoku clouds have to offer, that of identifying the trend at a glance. If the price is above the cloud, we can quickly conclude that the market is bullish and we can expect prices to go up. If the price is below the cloud, it is bearish. We are in a downtrend with prices continuing to fall. What happens if the price is inside the cloud, you may ask? This can also be interpreted quickly and easily. If prices came into the cloud from below, where there was a red cloud, this is still bearish territory. If prices came into the cloud from above, where there was a green cloud, the trend should be considered as still bullish. However, whenever you see prices inside the cloud, no matter from what direction they entered it, you should not commit to any direction. Why? Very simple. In an uptrend, the cloud is expected to provide support, as you have already seen in the charts I have shown you. On this chart, you can see how the cloud acted as support when prices were entering it from above. However, how do we know when the cloud will no longer be able to provide that strong support, thereby making a transition from bullish to bearish? We don't. In fact, once price produces too high of the bars below the cloud, we can consider that the trend is now down. The crossing barrier is the span B, but in my opinion, it is not enough if prices print slightly below the cloud, as in the second support on this chart. Just like with trend lines, I prefer it if at least two highs below the cloud are produced before we can change our view from bullish to bearish. Conversely, if prices are below the cloud and the market is bearish, once that prices enter the cloud from below, the trend will continue being bearish until at least two lows of bars are above the cloud. That way, you will reduce the amount of false signals. But I should say that in time, you might want to adjust this rule to something more flexible and in harmony with your own trading style. What I am suggesting here as a rule is actually completely arbitrary and based on my trading personality. Your own observations and experience will be the best guide. Now back to our cloud. From what you have seen so far, we can conclude that the way that prices interact with the cloud is of supreme importance. Very often you will see prices turn right on the edge of the cloud. Of course, cloud touches aren't always precise, so you have to give it some room. But as a general rule, you can consider that if the market is in an uptrend, the top of the cloud will be the first level of support, and the bottom its second level of support. Once those levels of support or resistance are cleanly penetrated, you can consider that the market is now transitioning from one state to the other. In order to simplify this concept further for you, I have eliminated all the components of the cloud, save the cloud span B, which will be the extreme high of the cloud in a downtrend and the extreme low of the cloud in an uptrend. This would be our second level of support or resistance. If price penetrates those levels of resistance, the market will be transitioning from bearish to bullish. Once it penetrates the levels of support, it will be transitioning from bullish to bearish. You can see on this chart how once price penetrated the span B from above, the market turned bearish. Later, it penetrated it again, but this time from below, so the market transitioned from bearish to bullish. The next penetration from above sent the market down in a rather large decline. Now let me clarify something of great importance. I mentioned that in an uptrend, The top of the cloud will be the first level of support and the bottom its second level of support. In other words, span A will be the first support and span B the second level for deeper corrections. But hold on, didn't I say the same about the turning line and the standard line and even gave you an example with this chart? So let's use the same chart but with all the components of the cloud on it. My purpose is not only to clarify the concept of first and second level of support, but to expand upon the fantastic information that the cloud provides regarding support and resistance. And if you have any doubts about the transcendency of these concepts, remember that support areas have a functionality beyond theory. Those concepts are a lot more practical than they seem. In fact, it is precisely the support levels that experienced traders use to place their buy orders. Support is also used to place your protective stops. If you are buying the market, you certainly want to buy at an area of support, and your stop must be placed below that support area. Why? Because if the support area is penetrated, the market will have transitioned from bullish to bearish, even if temporarily. The same thing could be applied to resistance areas in bear markets. So identifying areas of support and resistance is absolutely key to success in trading. And the cloud provides you with clear levels of support and resistance that are otherwise invisible to the naked eye. And the good news is that 4 of the 5 components of the cloud work extremely nicely in providing you with that information. Notice how on this chart, price found support at the standard line or slow-moving average when the retracements were deep, and on the turning line during shallow retracements. Once the uptrend was in need of a much larger correction, it was the cloud itself which offered support. You can even see how prices at some point pushed a bit below span B, but no highs of bars were seen below the cloud, keeping the uptrend intact. So what are the 4 components of the cloud that help us identify support and resistance areas? First, we have the turning line for shallow pullbacks. Then we have the standard line for deep corrections within a major swing. Third, we have the cloud span A on larger corrections. And lastly, we have the cloud span B on deeper retracements within larger corrections. Analysts and experienced traders are aware that the market often stops in places that don't show a historical level of support or resistance, a trend line, or any other sign that would have given any warning of a potential turn in the market. But if you change to an Ichimoku cloud chart, you will find that those invisible areas of support and resistance are clearly showing in the cloud. We have already discussed many of the most important elements of cloud charts, and there is one particular aspect that most people wonder: the cloud's look. You may have noticed that clouds become thinner or thicker at different stages. They are thickest when prices are accelerating in the direction of the trend in the shorter term. That causes span A to move quickly and farther away from span B. When that happens, it is a sign that prices will soon enter into a consolidation period or reverse altogether. Span A will then try to close the gap that separates it from span B, and eventually it may cross it. When span A crosses span B, the cloud changes direction and color, and if the new direction is sustained, prices too will cross the cloud. So it is important to remember that if the cloud starts to become thinner from an unusually fat state, you must consider it as a warning that the trend could change at any moment with prices crossing the cloud. That tells us that thin clouds, after being unusually fat, give us an idea of when the market is likely to change trend. All that explains why the cloud is often thicker at turning points, as you can see on this chart. Let's take advantage that you already know so much about the Ichimoku clouds and give a quick and easy analysis of this chart so you can have an idea of how easy, fast, and useful cloud interpretation can be. The first thing to notice: the price is below a red cloud, which is clearly bearish. Next, The cloud became thickest at the bottom, which typically occurs at turning points. Next, after being unusually fat, the cloud became very thin and unable to act as resistance, thus allowing prices to penetrate it. As you can see, once prices penetrated the cloud from below, it gave us a buy signal. Remember, if prices are above the cloud, it is bullish. Below the cloud, it is bearish. Hence, one of the trade signals the cloud provides us with is precisely when prices are above or below the cloud. Notice that the lagging line also penetrated the cloud, confirming the buy signal. At the extreme right of the chart, the cloud has changed color from red to green as a result of span A crossing over span B. That is also a bullish sign. Of course, it's not always that simple to read and interpret a cloud, so we must clarify what are the main signals that we can take from Ichimoku clouds. We have already mentioned the majority of them, but in this video we will discuss further the two main ones. First, price crossing the cloud. We have already discussed that if today's candle is above the cloud, the trend is for higher prices and the cloud will be expected to provide support. Conversely, if today's candle is below the cloud, the trend is bearish and the cloud will become resistance. But we also discussed that those signals are not reliable, so I suggested to see two lows above the cloud to consider a buy signal as valid, or two lows below the cloud to validate a sell signal. To make these examples clearer to you, I have erased all components of Ichimoku save the cloud. That way, you can see clearly where prices penetrate the cloud. You can see three price cross signals marked with circles that failed. The first one was a sell signal given by prices crossing below the cloud. It had two closes below the cloud, but that was obviously not enough and prices bounced back up. The second signal was a buy signal with prices crossing the cloud from below. This time, not only we had closes above the cloud, but we also had two lows of bar above it. Yet the signal failed dramatically. The third signal was also a sell signal that failed after prices had penetrated the cloud. Of course, you can use variations to the price crossing the cloud signal. For instance, you could enter long if today's candle closes above the cloud, and exit the trade if it becomes evident that it is a false cross, as in these examples. It all depends on how aggressive you are as a trader. More conservative traders will prefer to wait on the lagging line crossing the cloud, which is generally a more reliable signal. And that's the second way. Lagging line crossing the cloud. Typically, the lagging line will be crossing the cloud after the price has already done so. But that's not always the case. You will find some instances in which the lagging line will be crossing the cloud ahead of price. The fact that the lagging line nearly always crosses the cloud after price has makes the signal more reliable because by the time it occurs, the trend has already changed. Hence, the lagging line crossing the cloud is the true confirmation and the most reliable signal. Think about it. By the time the lagging line crosses the cloud, especially if you had a long trend beforehand, it implies that price will have given you already a buy or sell signal and be already in the new counter trend territory. This implies that failed lagging signals are less common. Of course, you will have fail signals, but less often than with the price crossing signals alone. Let's examine the first signal in the chart we just saw, but we will add the lagging line to the chart and move it to the right so you can see what you would have seen at the moment of trading it. Notice that by the time that price crossed the cloud from above, the lagging line was still far above the cloud, thereby preventing us from entering short. If we were using the lagging line as our preferred trade signal. In this example in Euro, you can see a horizontal line to indicate the exact bar where the lagging line crossed the cloud. It is important you understand that by the time the lagging line crossed the cloud, price had already done so for 4 days. I also included a trend line on this chart. This is a valid 45-degree trend line, which had been defining the trend as up for several months. That trend line was penetrated several days before price crossed the cloud to the downside. There are two important things I want you to notice with the trend line break. First, by the time it was broken, the turning line had already crossed the standard line, giving you further evidence that the trend was about to change. Second, you'll also notice that the lagging line crossed the trend line before it crossed the cloud. That can also be considered as a sell confirmation signal. By adding a trend line to the cloud chart, we also added the possibility to stack further evidence in our favor. Let's go step by step. First, you see the cloud was thickest at the top, indicating a possible turn or consolidation. Then you see the turning and standard line bearish crossover. Next, you see prices breaking an uptrend line that has been defining the trend as up for months. That by definition means that the trend has changed. If we had looked ahead while price was breaking the trend line, we would have already seen that the cloud had become really thin and red ahead of time. And you already learned that when clouds become thin after being unusually fat, it gives us an idea that the market is likely to change trend. All those are unequivocal signs that we should sell the market. However, conservative traders still would wait for prices to cross the cloud as it did 3 candles later. And even more conservative traders would wait for the lagging line to give the confirmation by waiting for it to cross the cloud as well. I hope this lesson with its examples shows you the completeness of Ichimoku clouds as an analytical tool. In fact, you can make a full analysis of any market just using what you have learned in this short course.
If you're finding value in this course and you want to continue diving deeper into technical analysis, trading strategies, and trading psychology, don't forget to subscribe.
The knowledge of Ichimoku charts that you have acquired in the past few videos alone will most certainly allow you to produce great accurate analysis and forecasts on any financial instrument. But I should point out that Ichimoku cloud analysis does not have to be made in isolation. You can successfully combine it with any of the other tools that the vast universe of technical analysis has to offer. As an example, I did exactly that when in the last video we used the break of a trend line to confirm the trend change with the cloud. At this point in your analytical capabilities, you can easily combine cloud charts with candlestick charting techniques or bar analysis. Doing so would provide you with the possibility to stack even more evidence for your positions. That in itself will be of a superb value in your psychology. When your trade positions have a gigantic foundation that accumulates evidence that argue in your favor, your psychology will automatically be transformed. That's another side effect of a good foundation in technical analysis. Let's look at an example. You can see in this chart how a multiple key reversal had occurred at the top. It was also the reverse 3-in-1 pattern. This combination is a very powerful pattern that announces a potential major change. Notice how the outside bar engulfed the 3 previous bars, and at the same time it closed below the closes of the previous 6 days. The setup bar, which in this case was also the multiple key reversal bar, found support on the standard line, but it broke that support at the opening of the very next day. It didn't take long after breaking the standard line support to also break the uptrend line and at the same time cross the cloud itself. If you look carefully, you will notice that the break of the cloud was accompanied by several closes below span B support. A couple of days later, the turning line crossed over the standard line, giving us further confirmation of the trend change, a change that the break of the trend line had already announced. And a few bars later, the lagging line gave the final confirmation sell signal with the cross of the cloud and the break of the trend line. Notice how we stacked a lot of evidence in our favor to confirm that a selling of this market was more than justified. That should give us confidence in our decision as well as a good foundation to manage our position in the future. For instance, with so much evidence of a major trend change, the attempted rally that occurred later should not have scared us in the least. We would be expecting with a high degree of confidence that span A will offer the first resistance and send prices lower. That resistance level can also be used to add to our short position. Now, I would like to discuss in further detail the valuable information that can be used in our daily analysis by using the lagging line beyond the basics of what you have already learned about the lagging line and how it interacts with the cloud. The first thing to consider is how the lagging line relates to price as well. Theoretically, when the lagging line is trading above the candlestick of 26 days ago, then today's market is considered to be in a bullish long-term phase. On this chart of yen, you can see the lagging line is very much above the candle of 26 days ago. That information, along with all the other information that the cloud provides you with on this chart, argues for yen to be in a long-term bullish phase. You can see that the thickest part of the cloud was at the bottom, indicating a potential consolidation or a reversal. Price went on and crossed the cloud to the upside. Such a rally was maintained long enough for the lagging line to also cross the cloud. That's a bullish signal. Notice that the retracements were first supported by the fast-moving average until a larger correction was needed. At that point, it was the standard slower-moving average, the one that gave support to the pullback. Also, bullish signals. At this point, we can forecast that any larger retracement that might be needed will be expected to find support on the cloud, first on span A, and if need be, the cloud itself or span B at a later time. Conversely, if the lagging line is trading below the candlestick of 26 days ago, then today's market should be considered to be in a long bearish phase. Such is the case of the euro on this chart. You can see how the lagging line is much lower than the candle of 26 days ago. That information tells us that the current rally we see on the chart should encounter resistance on the cloud, first on span A and later, if needed, on span B. But the long term should be considered bearish, which allows us to forecast with a certain degree of confidence even lower prices for euro ahead. Obviously, this analysis also has practical trading implications. For instance, should prices continue moving higher in euro, the resistance offered by the cloud will present us with a perfect opportunity to sell and or add to our existing short position. The exact same concept applies for the lagging line in regards to the cloud, meaning that if the lagging line is trading today above the cloud of 26 days ago, then the market is bullish and vice versa. As you can see, the lagging line, when seen in relation to price or the cloud itself, can still give us more information which can be used for trading decisions and forecasting purposes. Another important piece of information regarding the lagging line is that trend lines, the turning and standard line, as well as span A and B, will act as support and resistance to the lagging line. As we discussed in a previous lesson, knowing those levels of support and resistance is absolutely key in your trading and analysis. Therefore, it is a good idea to make a list of those levels before you start your trading session. Finally, I would like to point out something that could be interesting and have practical applications for you. Many technicians consider the lagging line to be the most important of all lines involved in a cloud chart. Some technicians are happy to use only the lagging line and the span B on their charts. As we discussed in a previous video, the lagging line signals are indeed the most reliable, and they occur when the lagging line crosses the cloud. And as you already know, the extreme of the cloud is actually span B. Therefore, using the lagging line in combination with the span B is all that is needed for a trade signal. For this example, I have chosen to show you a 60-minute chart. The reason is because this application is more appropriate for people who want to use the cloud simply as a trade signal and not as an analytical tool. Personally, I prefer to have all the information that the Ichimoku provides and not just what two of the components give me. But for the trader who wants to have reliable signals with more probabilities to win while scalping, This setup is more than sufficient. You can see the first cross on the upper left part of the chart, where the red arrow pointing down is. The cross of the lagging line, the blue dark line on the chart, over span B from above translated into a large sell-off. One advantage of this method is that you would remain in the trade until the opposite signal appears. That occurred where the blue arrow pointing up is. Notice that just using the signals given by this methodology on this time frame could be extremely profitable. Naturally, if you combine any entry signal provided by the cloud or any other strategy with the top indicator, you will ensure a still higher probability of success. For this example, I'm going to use a 1-minute chart with the lagging line and the span B. Notice how the lagging line gave the sell signal at about 9:35 a.m. At the same time, the span B served as resistance when price tried to recover. Now look at the exact same time when the top setup was showing. You got the sell signal at the exact same time, and combined with the cloud, you had a clear view of where the next resistance was and can expect that resistance to stop the rallies. The clear knowledge of the location of that resistance can also help you decide where to place your stop. I hope this example shows you how using what you already know about Ichimoku clouds combined with our top indicator opens even higher probabilities of success for you. In fact, with this knowledge and these tools, all you need now is discipline and a good trading plan. In the last video, we discussed in depth the interpretation of the information that the lagging line provides us with, and we also explored a more practical way to use the clouds for trade signals. In this video, I would like to start by showing you how the cloud also helps our thinking process. Take, for example, this chart of oil. Notice that there is a key reversal at the top, forecasting a potential change in direction, which indeed occurred. However, so far the cloud had been acting as a strong support, not allowing prices to go below it. So we need to ask ourselves, was that just a deeper correction similar to the previous one within the blue rectangle on the left before prices continued in the uptrend? Or is it a real change in trend? Notice that the deep correction within the blue rectangle on the left in January-February 2018 was also stopped by the cloud and prices went back up. So how do we know that it is not going to happen again, particularly when there was another key reversal at the bottom of the cloud that already sent prices back up? The answer is simple. The cloud tells us exactly what will need to happen to indicate that the trend has changed beyond a deep retracement. First, prices will have to break cloud support in the next few days. That appears to be extremely possible, given the fact that prices are very close to it already. But also, if you look a bit ahead, you will notice that span A has already crossed span B. That crossing forced the cloud to change color, announcing a potential downtrend by July. Sometimes the most obvious, or at least closer sign of a trend change, can be the span A and B crossing at the extreme right of the chart. This by itself is also a signal. Of course, we know that the most reliable signal will be when the lagging line crosses span B. So even though we see the cloud changing ahead of time, we want to wait for some of the other confirmation signals, such as price crossing the cloud, or better yet, the lagging line making the cross. That means that by July, when the cloud is already red, span B will be at approximately 65.35. That means that prices will need to break the 65.35 area before the lagging line crosses the cloud, giving us a confirmation sell signal. While I understand this thinking process is not very easy to teach, this example should give you an idea how you can use the cloud to forecast and see what price will need to do or what will need to happen in order to confirm a trend change. But from my perspective, it is important to have patience and wait for the confirmation signals. For example, had we turned bearish during the first deep correction shown in the blue rectangle, because the cloud had already turned red, we would have had a bad surprise. But notice that while the cloud had turned red in April, the lagging line, 26 bars behind, was still above the cloud, and there was not a single hive bar below the cloud. So having patience and the discipline to stick to our rules often protects us against bad decisions. And that brings me to discuss how important are the other signals that the clouds provide. Let's talk about the signals offered by the crossing of the turning and standard line that we discussed in one of our previous lessons. Are those signals reliable enough as to be taken without the other confirmations we have presented? For instance, on this chart, you can see inside the second blue rectangle, the turning line crossing over the standard line. But if you look carefully, you will notice that the crossing occurs pretty much at the bottom, right before the key reversal. Is there a solution to this problem so we can take advantage of the moving average crossover? The answer is absolutely yes, as long as you follow these three conditions. The first being, the positions taken with such signals are to be considered as short-term positions unless other signs tell otherwise. So a strict exit strategy should be respected. Second, only take the crosses that go in the direction of the trend. So in an uptrend, you would buy on the fast-moving average crossing up the slow-moving average. In a downtrend, sell when the turning line crosses below the standard line. And lastly, as an exit strategy, exit when they cross again in the opposite direction. On this chart, we see a clear uptrend in the middle of the chart. Prices are above the green cloud and the two moving averages have been serving as support. The lagging line is also in the bullish territory. At some point, where the first circle on the left is, the turning line crosses below the standard line, giving a signal to sell, yet prices kept moving higher. Are these moving average crossover signals that bad? Not at all, but there are two things you have to consider here. First and most obvious, the market is in an established uptrend, hence all sell signals are to be ignored. Only buy signals should be taken. And second, the standard line is still moving up. Always ignore those signals. If you want to take the moving average crossover signals, do so when they move in the same direction. For instance, in the blue rectangle, you can see another situation in which the turning line crosses over the standard line from above. But notice on this occasion, the standard line is also moving downwards. As a result, even though the trend was still up by definition, the signal turned out to be a great signal. Now let's go back to the second moving average crossover signal within the second circle on the right. Notice that on this occasion, the signal was a buy signal because the fast-moving average was moving above the slow one. And since the market was in an uptrend, this is a valid signal that should be taken for a new short-term position or to add to an already existing longer-term position. Here is another example of moving average crossover signals that should be taken simply because the crossover is in the direction of the main trend. In this case, we are looking at euro. Notice that the lagging line had already given the sell signal and the market was already, by definition, in bearish territory. At that point, where the first circle is, the turning line crossed below the standard line, giving another sell signal, and in this case, an add to position signal. Several weeks later, where the second circle is, the fast-moving average crossed once again the slow-moving average to the downside. That was another sell signal, and in this case, since we were already short, a sign to add one more position to our already existing ones. These simple examples and analysis show you how to add safely to your winning positions and when to take the crossover signals safely. One question that we often get asked is if it is possible to scalp with the cloud using counter-trend strategies. My answer is there are several ways to scalp using the cloud. One of them is simply using its signals in a very small time frame. That way, you would be trading with the very short-term trend determined by the cloud. In this example, we're using a 1-minute chart just to show you the potential for scalping purposes. Notice how at the top there was a 2 moving averages crossover to the downside. Right after that, price penetrated the cloud, getting into bearish territory. Now, it is not only price below the cloud, but also below the turning line, which we already know is a bearish sign. To make the setup perfect, the lagging line crossed over the cloud a few bars later, giving a setup worth more than 60 ticks. If you have questions about why you would have stayed in this trade for that long, just look at all the other signs you have already learned about the cloud. For starters, notice how every early rally attempt found resistance on the turning line, as it is expected during early corrections in trends. Once that a deeper correction was needed, price went all the way to the standard line, which also stopped price cold. Now, look at the beautiful entry that the top indicator gave you at the exact same time that the lagging line penetrated the cloud. And think for a moment how confident you would be taking trades with the top signals that are confirmed and justified by the cloud. Notice that recognizing the clear areas of resistance that the cloud offers would also make it extremely easy for you to trail your stop with confidence. At the end of the day, a stop should be placed beyond the support and resistance areas, not according to how much money you would like to risk. And here's another trading strategy. There is another situation in which a counter-trend trade based on the signal provided by the crossover of the turning line and the standard line is acceptable. When price has moved a long way away from the cloud or fallen a long way away from the cloud. At that point, you may find good scalping opportunities, but remember, trading with the trend is the most effective way to operate. Counter-trend trades are very risky. On this chart of Aussie CAD, you can see 2 clear examples. I drew 2 black vertical lines to show you how far price had separated from the cloud on those 2 occasions. A few bars after the long stretch, there was a cross of the turning line over the standard line. In the first example, the cross was to the downside and the trade was highly successful. In the second example, the cross was to the upside, and again, the trade resulted in great gains. But both these trades violate one of the most basic rules in trading. Don't sell when you see a support right below the price, and don't buy when you see resistance right above the price. You can see that in the first example, the cloud was working as support, and in the second instance, the cloud was right above price. So this approach by itself is not recommended in top. However, there is a solution to this problem, and that is using multiple time frames in your analysis. If the price goes far away from the cloud in a large time frame, you can then go to a smaller time frame to find opportunities as counter-trend trades. Let's use the same example we used earlier in Aussie CAD. That was a daily chart. I have added a blue rectangle so we can easily identify the same place in a 4-hour chart. Remember, the idea is that we can trade against the trend in the daily time frame, but with the trend in a 4-hour chart. The first step was to identify a great separation between price and the cloud. That warns us that price will want to close that distance. If we take the crossover signal in this time frame, we would be buying with cloud resistance right above us. So we move to a smaller time frame. In this case, I have chosen to move to a 4-hour chart to find a buying opportunity when the cloud is below price. Before, however, we move to the 4-hour chart, I want you to notice that the first buy signal here appeared at about 0.9753. This is the same chart, but I have changed the time frame to 4 hours, keeping the blue square so you can see the same spot. The difference is that the buying opportunity in this time frame is completely legit because now the price is above the cloud. And taking the first lagging signal, we could still enter this trade at 0.9680, 70 pips plus cheaper than if we had taken the crossover counter signal in the daily chart. So the strategy here is simple. Whenever you spot price separating a great distance from the cloud in a particular time frame, move to a lower time frame and wait for the proper signal. That's the beauty of multiple time frame analysis with a sound system like the cloud offers. The relationship should be more or less like this. If price separates from the cloud on a daily chart, use a 4-hour chart as a trigger chart. By a trigger chart, I mean the chart from where you would take your trade signals. If you spot the price separation on a 4-hour chart, then you may want to use an hourly chart as your trigger chart. You would take your trade signal when the lagging line in the 60-minute chart crosses the cloud. If your time horizon is a lot lower because you are more of a scalper, you can use a 15-minute chart to spot the separation of price from the cloud. Your trigger chart in this case would be a 5-minute chart. This is a monthly chart of the NQ. There is no question in our minds that the trend is up, and it has been up for several years. However, this chart shows us an important piece of information. Price is at its largest separation from the cloud in years, so we can be on the alert in a smaller time frame for signs of possible corrections. Based on this chart, we can put the first support at 65.28, where the fast-moving average is currently located. So even a small correction in this time frame has the potential to move down more than 400 points. The second support is currently at 56.91. That's where the standard line is now located. So a deeper correction could take prices that low. But should we wait for this time frame to give us a signal? No! We have already spotted a large distance that separates the cloud from price. Now we move to a smaller time frame and look for opportunities with the trend in that lower time frame. In this case, we're moving to a weekly chart where a simple and quick view does not forecast a correction in the next few weeks. Just look ahead at the cloud and you'll see that span A is still far away from span B. If there is a correction that we can participate in, it's not going to be for the next few weeks. You can see with this example how simple the whole analysis and forecast with the cloud can be. There are still dozens of trade possibilities and analysis with the cloud that we can explore. But this course has extended a bit too much, and it would be impossible to cover all possibilities in a single course. The cloud by itself can easily be an entire trading methodology. Let's just say that every tool in technical analysis can be combined with cloud analysis to be even better. So what about you as a top trader? The simplest summary of cloud application for a top trader using the top signals is this. The cloud will tell you at a glance whether you are in a bullish or bearish trend. With that knowledge, you will know exactly what signals to take from the top indicator and what signals to ignore. That will save you from sideways markets. For instance, if the cloud shows you a bullish trend, simply ignore all the sell signals from the top and vice versa. Good luck in your trading.
If you have any questions or insights, leave them in the comments below. We're always happy to engage and help out. Enjoyed this video? You're definitely going to appreciate this one.